Hey, everybody, welcome. Glad that you can join us for, what meeting is this on Paycheck Protection Loan Forgiveness?
Number 5.
Oh, it's number 5? Oh, I thought you were just waving to me. It's 5 on forgiveness? Good, I'm glad we've had 5 to get through this and totally figure it out. We've got it all locked in. We know all the answers, nothing else will change.
Right.
I'm kidding. I'm kidding. But there's more changes, more things pending, but we've got a lot more answers. We've received a ton of feedback from people, and I think Caryn has done a lot. We've just been reviewing some of the changes, and I'm excited about what you're going to cover with us today, Caryn. Also want to tell everybody we're recording this to the cloud, so the recording of it should be available pretty quickly this afternoon. We've sped that up a little bit, and we'll have the slide deck for everybody available then as well, right?
That's great. We sure will.
All right,
well,
I'll turn it over to you, Caryn.
Okay, well, wonderful. Well, thanks for having me again, Charlie. I'm delighted to be here, and this topic is going to be particularly fun. It's maximizing your PPP loan forgiveness. And to start out with, I thought I'd put up a fun quote that Forbes had online on May 31, which I think really says it all. The biggest problem with the new regulations that you'll likely need a lawyer, an accountant, and an advanced degree in mathematics to figure out how to calculate the forgivable portion of the loan. So if you're getting confused as we go through any of this, don't worry about it. It's acknowledged by every organization in America that this is a complicated subject. And we're here to try to help and make it feel simpler, but just know that it is a complicated subject. A little disclaimer up front, MissionWell, speaking of needing accountants and lawyers to get through this, we are not either one. We're not an accountant firm, and we're not lawyers either. What we are is we're a virtual office that we support churches, we support religious organizations and nonprofits. We have a variety of services for them, gift handling, accounting, human resources, financial consulting. And so this work falls into some of the work that we do for our different business partners. And because we're doing it for our business partners, we have to learn about all the rules and in order to help them complete their forms. And so what we're doing is just offering this as an additional service, to you as well. But thank you for joining, and hope that this will be useful to you.
And Caryn?
Yes.
I'm going to just let you know that we've had a couple comments about a dark box on the screen. Do you see that? Do you see the dark box? I see it on my end.
You know what? Is it this? Did I move the box? Did the box move now?
Nope. Click on it. Oh, I think it's getting better. Keep moving it.
Okay. I'm just moving the webinar information way over on my screen. Can everybody see the actual slides now? Just so you're getting any feedback, Charlie, that everything's good? Better.
If you can move it a little bit more, that might be helpful, but I think we've got it in pretty good shape right now, Caryn Ryan.
Okay, so how's that? That's probably the best I can do. That's all the way over out of my screen.
There's one more up at the top of the that side. I don't know if I'm pointing in the right direction or not. It's covering paycheck protection.
Okay, that's Zoom doing that. That's Zoom doing it. So it should.
That was weird.
Yeah.
Oh, we're getting Zoom bomb. Move it.
Yeah.
All right.
Zoom doing that. I can't do anything about that, but hopefully it'll just go away. I'm hoping it'll just go away. Let me see. I can try to do. Let me try to stop share and see if I can share differently really quick. All right, that's the only thing I can think of.
If not, I can do it.
Right.
Look at that. Look at that.
Is that better?
Everybody see it? Yes.
Okay,
yes,
great.
Better.
All right, I just did a reshare, and that seems to have fixed it. Okay, wonderful.
Okay.
So the let's see. Let me go back here and see if we're. All right, so in terms of what we're going to cover, we'll look at what's happened since the last webinar a week and a half ago. We do have a House bill that's moved to the Senate, and we'll review what some of the key parameters of that are. We'll then talk through enough material to give you a high-level understanding of how forgiveness works. When you're actually filling out your application, what you're going to see is that it's like filling out your tax form. You have no idea in that line what the big picture is for why you have to put this information on your tax form. So the forgiveness loan is starting to feel like kind of like filling out your tax form. And so what we're going to try to do is give you this conceptual understanding, and then that should help you as you are filling out the application. We'll go through eligible costs, then we'll go through the wage and salary, the salary and wage reduction. We'll go through the FTE reduction, and then we'll go through the safe harbors for both of those. And just know that there are still unanswered questions. That's been the case with throughout this process, and it continues to be the case that there are still a lot of unanswered questions. So we can't answer all your questions. To go through this, we'll basically go through the loan application components. We're going to do the concept review, and then we're going to do a detailed review. If there's time, I'm actually going to pull up our spreadsheet. So MissionWell has developed a spreadsheet, and the spreadsheet is more conceptual, but it gets you to all the information, pretty much all the information that you'll need to fill out the form. But it's easier because I think you can understand where you're going with it. You can kind of see what leads to what. So I'll try to spend some time on that if we have the time, and we'll go through the spreadsheet. I'll say this at the end of the webinar too, but if you want the spreadsheet, you can email info@missionwell.com to get the spreadsheet, and we'll send that to you. So I won't go through this because most of you, if you're listening, you've already got the loan, but this is just a slide to remind you that the CARES Act, which was passed March 13 of this year, allocated over about $650 billion for this program. There's still $100 million left, and one key aspect of this is the forgiveness provisions during an 8-week period called the covered period or forgiveness period, but it's called either one after the loan is dispersed. So when the loan is dispersed, that's day one. You're in the forgiveness period, and basically to get the full loan, you will need to either maintain employment and levels and wages, or make it up, get it fixed by, at this point in time, June 30. The government views this program as a substitute for unemployment to the maximum extent possible. I think the views of what the program is intended to do are in flux right now, but at the time this was passed, it was viewed as a substitute employment plan, and everything related to the way that the program has been put together has related to that objective of being a substitute employment plan. The loan does convert. I mean, the unforgiven portion, if any, would convert to a 2-year loan with a 6-month grace period and 1% interest, which is really cheap and really good money. So if you're wondering about whether you should keep the money or not, my recommendation is that you do it. I won't go through the rest of that because we really want to spend most of our time on the application. But I do want to just talk through here the fact that the PPP Flexibility Act would amend the forgiveness provisions. It's still not passed, so we don't know what would, A, will this pass? And B, if it does pass, will it be in the form that the House provided, or will there be amendments to it? But this is information from the House draft that the Senate is considering right now. I do think that there's a couple of positions within the Senate, very influential people within the Senate who have been coming around and who are actually saying that they favor passing this or something like it. So I think it's likely. Unfortunately, we only have what we have right now. So what you're going to see is based on the law that is in place today, and particularly if you have a forgiveness coming up and you want to get that done, this is the tool that you have for your forgiveness. A lot of people who got round one PPP loans, their forgiveness period is ending this week, so it's basically done. But if this passes, it could reduce the amount of the loan needed to be spent on payroll. Right now, it's required that you spend 75%. That could fall to 60. So again, for people or for organizations that are heavy on non-people costs, that could be a big help to you. It extends the window to use the funds from 8 weeks to 24 weeks. So that's 3 times longer. A lot of people have been trying to say, look, can I accelerate this compensation or that compensation in this period? You don't need to worry so much about that if you have 24 weeks. That's, close to 6 months. So that's a real benefit. It pushes back the June 30th deadline to rehire your workers and fix their salary and hours to December 31. Now, the initial thinking behind the original PPP was that this was a quick, that the pandemic would be over, the crisis would just be over, and that June 30th was, in their view, the end of that. So the people needed to be rehired. I don't think people feel the sanguine anymore about that. So this is adapting to a different reality. Provides more leeway for business owners who show they couldn't rehire workers due to safety standards. There are many businesses, and you may have some of these, where you've got, if you have kids coming, if you're a school, you're not going to be able to seat or teach the same number of kids that you did before. So your forgiveness will be adjusted if you're in the kind of ministry that is requiring, for health reasons, a change in how you deliver your services, and that may have an impact on employment. And so the government is going to be trying to figure out how you would be able to get some forgiveness even so. It extends the time that recipients have to repay the loan, and lets companies that get loan forgiveness also possibly defer payroll taxes. So that's been one of the things that you haven't been able to defer your payroll taxes if you're participating in this. It's been one or the other, and it could turn out to be both. So those are some of the changes.
So Caryn, yeah. Hey, Caryn, I think the advice that you'd have on this is that we need to continue to prepare under the current guidelines and hope that the Senate can get together and pass this in the next week or two. And if that's
Yes.
the case, then we're already going to be in a good spot, because, believe it or not, sometimes things don't happen in DC. This was hot news a week ago, and that was prior to a whole lot of other things happening, and we don't know if they're going to get around to passing it. It did have almost 100% approval in the House, and so it seems like the Senate would pass it, but we don't know. So bottom line is, keep going through things as they are right now, and then we might have a little bit of relief coming up.
Yeah, I still think you're going to have to fill out the application, even if it has more lenient terms. So it's a really good thing to understand the loan application itself. I doubt that that's going to change too much. Learning how to fill it out it's just going to mean that we're going to have to add more columns for a longer time and change a few, ratios and percentages. But it's still a really good thing for you to figure out what do you have to do to get this forgiveness application done. Does that make sense, Charlie? Okay, so loan forgiveness, this is, using the current terms, your payroll cost are qualify as forgivable, and it's using the same definition that you use to put your loan together. It's there's the definition is unchanged. Payroll costs need to be at least 75% of your loan forgiveness. Your forgiveness will be reduced if your payroll cost is, only, let's say you have $100 of qualifying costs, and your payroll is only 60 of the 100, then you're only going to get loan forgiveness of 80, because it has to be 75%. The payroll component needs to be presently 75%. The things that count are salary, minister's housing allowance, wages, taxable allowances, tips, vacation, and sick, parental leaves, a group health care, other benefits the employer pays for, severance and other kind of costs of releasing employees, a lot of your dental hypothetically, your any kind of healthcare qualifies. Although you'll see later on that I'm saying, you know, the vision and dental doesn't appear to be on the application, but you know, the advice is really to put it in the healthcare, your dental, your vision, and the other things. And then also in the spreadsheet itself, I'll mention this probably at least one other time. You know, if there's something that seems like it's possibly going to be forgivable, but you're not sure, just highlight it. Put it in the spreadsheet, track it, monitor it, and then just highlight it. So, you know, as things become more clear, which they are clearer now than they were a week ago, and they're clear a week ago than they were 2 weeks ago, then you can decide whether to remove the highlights or not. You know, those kind of healthcare related, like the vision and dental, if it becomes clear later on that those are not allowed, then you can just take that out. But it's easier to put everything in right now and then just take it out later. Retirement contributions, that included some self-funded plans, state and local tax payments that are assessed on payroll. So that might be if you're in the state of California and unemployment is assessed based on payroll, then you could pick up any employer portion of state of that kind of a tax. Okay, so the employer portion only, not any employee portions. At the last webinar, somebody asked about FICA, and it was a little confusing, and I want to just say really clearly here, no, that is not a qualified cost. The federal taxes are not includable in there. So it's just if there's a state or local tax payment or tax-like payment that's based on payroll. Mortgage interest is on real or personal property if it's incurred before February 15, 2020. So it's new? No. There's no prepayments allowed and there's no principal allowed. Rent is allowable if it was your lease was in effect before Feb 15, and if you renegotiated your lease, that's fine. That's the same lease still. It's just a renegotiated. You know, maybe you negotiated a reduction, put the reduced amount in, but that would count. And utilities, if your service began before Feb 15, 2020, that's fine. But if it started afterwards, then no. The law calls for the distribution of electricity, gas, water. Transportation would be things like you have a company car and you're paying gas for it. I assume if you have an electric car and went to a charger and paid for that would count too for transportation. Telephone and internet access, and then you're ultimately, once you add up all of these costs and apply any safe harbors here, once that's done, your lender will submit that application to the SBA. They'll approve it and submit it, and they'll get the forgiveness confirmation back. The SBA will also then, when they're doing the forgiveness confirmation, they will reduce the forgiveness by any amount of an EIDL grant that you may have gotten. So I know a lot of ministries went out and applied for and got an EIDL award. It just appeared in your bank account. Nobody told you what it was, but it was $6,000, $10,000, $13,000, whatever that amount was that you got after you applied for the economic injury disaster loan. That is a grant. That is the grant from the SBA, and they will deduct that from your forgiveness. Now, what's actually in the loan forgiveness package? If you look at it, there's a kind of a long package with very small print here, and it's many pages, and it's got 4 key components. It's got a core form, which is almost like a summary, and then it has a Schedule A, and the Schedule A computes the payroll costs, net of the standard reductions. And then it has Schedule A worksheet, which is calculating full-time equivalent employees and the salary and wage reduction amounts that are going to be kind of moved up to Schedule A, and then the Schedule A information will move up to the summary of loan forgiveness. So it's going from the high-level overall summary to certain calculations, and then the Schedule A worksheet is doing the employee-by-employee calculations. The employee-by-employee calculations need to be done for both the salary and wage portion, of the form, and also for the FTE, the full-time equivalent. So you're going to be on Schedule A, you're going to be capturing the data employee by employee. And then sometimes employees will be included in a calculation, and in other situations for the forgiveness, they might not be included, and I'll walk you through that. So that's where some of the complexity comes in, is the inclusion of, which employees are included in what calculation. There's also an awful lot of time frames involved in the in Schedule A in terms of figuring out forgiveness, and so we'll walk through those as well. It can get a little complex, so stick with me. There's also then finally a borrower demographic form. That's voluntary. You don't have to fill it out. What the guidance is for nonprofits is that if you do want to fill this voluntary demographic information out, you're going to fill it out for every single person who's on your board of directors. So if you have 7 people on your board, you'd fill out the voluntary demographic information for each of those 7 people. It's asking things like race, ethnicity, et cetera, so on. But it's completely voluntary. So let's get into some of the details then, first of all, on how the calculations are going to work, and then I'll show you where they are on the form. You're first going to calculate payroll costs and non-payroll costs, or other costs. So that's the, kind of a key thing to keep in mind. You've got payroll costs and you've got non-payroll costs. In terms of those payroll costs, there's no change in terms of what counts from the original loan application. I would say here that the reasonableness is something to focus on. You don't want to, from a compensation perspective, suddenly take your year-end bonus and move it into the forgiveness period, because it will increase your forgiveness. You need to be reasonable about what's going to be included there, and it needs to be based on how you would normally conduct business. The covered period is 8 weeks from the loan disbursement day. So loan disbursement day is day 1, and then you go forward 55. There's 55 more days, and then you're at the end of the covered period. There is an alternative.
Hey, Caryn?
Yes.
Oh, just a question about disbursement. And I know, what does it really mean? I mean, is it disbursement is when the loans or the funds were released, but it may not have shown up in your checking account that day. Is that correct?
That is actually true, that sometimes there's a day off from the disbursement, in which case you need to speak with your lender and say, you told me I was getting a disbursement on Wednesday, but I saw it in my account for the first time on Thursday. May I use Thursday as day 1? May I use that as a disbursement day? So you would go and clarify that with your lender, and I think there's a reasonable chance that they would say yes, but that's probably something between you and your lender that you'll have to work out.
Okay.
Once you've got day 1, then you're going to add 55 days to that, and then you've got all 56 of your days, or 8 times 7, or 56 days. And things that fall outside that period do not qualify. Okay, and we'll get into that in just a minute. The alternative covered period is now available, and that is for those organizations that have a payroll which is biweekly or weekly. Now, if you have a payroll that's biweekly or weekly, you're probably thinking, oh, that fits pretty nicely into an 8-week scheme. Well, the government thought so too, and they thought that might be helpful to you. And so they put this in as an alternative covered period. So if you have biweekly or weekly payroll and want to start your covered period, or your forgiveness period, on the first day of your biweekly or weekly payroll, the next payroll period, you may do that. And then that lines up your payroll very nicely, with the forgiveness period. And it will make your work, it will cut your work back significantly, because you're not going to have to allocate payrolls to the first and the last period. So that's a good thing to consider, whether you want to elect the alternative covered period. If you do elect it, you need to consistently use that throughout the form, wherever it's using the term covered period or alternative covered period. You can't take a pick this time and say, well, this time I want to use the first definition covered period, and next time I want to use the alternative. Once you've elected the alternative, you need to be consistent and use that throughout. Okay, or once you elect not to use it, you're going to be consistent throughout. Then in terms of calculating costs, the definition that's being used is the costs that are incurred and paid. So what does that mean? A cost is incurred, like a payroll cost is incurred if the employee earned the wages. So typically, if the employee worked during this period and was, gets paid for that work, then that's going to count as a qualified cost. It's the incurred or the earned and is paid. All right, now there's a couple of exceptions here. Number one, if you at the end of the forgiveness or the covered period, you may have a partial payroll. Likely you will have a partial payroll. And so you may worry about, well, if I don't pay it in the forgiveness period, am I going to lose that opportunity for forgiveness? The answer is no. There is an exception for that. As long as you make your payroll on time in the period, the first period that follows the covered period, that portion that belongs in the covered period, you can just allocate into there. Okay, so that's one exception. The second exception is that that's going to be a similar principle for those non-payroll costs. Okay, so you're going to be able to, if you pay a utility after the fact, but that utility would be forgivable in the covered period, then you can claim and get that, have that be covered. You can do an allocation or put that cost in. Okay, so it's kind of a mix of cash, paid, but at the end of the period, there's this ability to just pay your bill on its regular time and cycle. So you're going to need to do allocations both up front for the initial period, because the incurred means that if something wasn't earned or incurred, or the liability didn't come about in the 8-week PPP period, then you're going to have to do an allocation of a bill, of a payroll, or whatever it is at the beginning. So it'll be an initial allocation, and at the end of the payroll period, there will be, okay, and at the end of the period, that ending allocation, as long as you pay the bill, pay the payroll on time, earlier on time, if it's even 1 day late, you lose the forgiveness. So make sure you're paying all those bills on time. Okay, so now this is the start of the application. This is the top of page 1 of the application, and this is really just collecting basic data. So it's asking for your name and address and your DBA and some other basic information there. You'll see here that it's asking for your SBA PPP loan number. So if you go to your promissory note that you got from your lender, you'll find that number on that promissory note. Your lender may have given you another number, their own number. So if they gave you a number, you're going to put that here. And then you're going to put the amount of the loan and the day that it was dispersed. Okay, so again, you're going to talk to your lender. If your lender says it was Wednesday, but you didn't see it till Thursday, you're going to talk to your lender and you're going to put that day there. That's going to be day 1 then of your forgiveness period, is whatever date you put here. The employees at the time of the loan application, you don't need to calculate this, you already did it once. So you're just going to go back to your original loan application and just put down here what you reported then. And then you're going to put down the amount of your EIDL, your economic injury disaster loan amount, and you're going to put that application number there so the SBA can make sure that they're deducting that from your forgiveness. Then you're going to pick your frequency of your payroll. Most of you are going to be weekly, bi-weekly, twice a month, or monthly. So those are options that are shown here. And then you're going to pick your covered period. So now we talked about that. You've got a choice. You can either start it on the actual disbursement date, and you're going to add 55 days to that. So that'll be day 56 then, 55 days beyond that. Or you're going to look at, if you have the weekly or bi-weekly payroll, you'll pick the next payroll start date if you wish, and then you're going to add 55 days to that. So those are your 2 potentials for alternative for the payroll covered period. If you had a loan more than $2 million, you're going to check the next line, and you already know that you will be audited. If you're $2 million and there's a safe harbor, if you're below $2 million, that's only affecting your certification that you took out the loan with good faith. Okay, so for other reasons you could still be audited, but they will not come back and say if you're below 2 million that your good faith certification's a problem. Okay, so now before we get into the bottom of page 1, we need to review or look at very quickly here, how does forgiveness work? So, because page 1 is just going to summarize what I'm going to tell you, and then all the other details that we're going to get into all relate and come back to this, to how can we calculate these things. So it's great to know from a conceptual perspective, this is how we're going to calculate a couple of these key things. So there's there are limits on what will be forgiven. You're gonna basically calculate up all that information, and you'll see what's the gross amount that's available to be forgiven, based on what you've actually spent in the 8-week period. But the first limit then is if you've had a drop in salary and wages. So if you dropped your salary and wages more than 25% for any single employee, that's going to potentially reduce your forgiveness. And for this calculation, you're going to compare that to the first quarter of 2020 for the purposes of this first calculation. So you're going to have the first quarter of 2020, you're going to do some calculations on the first quarter, you're going to have your 8-week forgiveness period, you're going to do do some calculations of wages there, you're going to compare those, and if the 8-week period is more than 25% off or down compared to the other one, and this is employee by employee, then you're gonna basically, for each employee who got their pay cut more than 25%, you're gonna put an amount in, put it aside and say this is unforgivable. Now we'll come back to whether there's a safe harbor forgiveness that'll also work for you, but for right now, just keep that in mind. There's going to be sort of a gross unforgivable amount, which is if you reduce people's pay more than 25%. Now, a couple of points around that. It's going to exclude, this calculation will exclude highly paid employees. If they earned $100,000 on an annualized basis in any pay period during 2019, then you're going to exclude them from this provision. You don't need to worry about calculating the forgiveness if that employee was paid $100,000 or more. I've put in here a little table that just shows what does 100,000 equal in hopefully you have one of these pay periods. So you're going to just go look and eyeball and say, if your monthly pay was, did anybody earn more than 8333 gross of cash compensation? This is only cash compensation here. And if they did, they're going to be excluded. If you cut their pay in half, it doesn't matter. You're not going to have to take a reduction for that. Those employees are excluded from this calculation. Also excluded from this calculation is any employees who are residing outside the United States. In fact, that's true for the entire loan forgiveness. All these calculations, their costs will always be excluded. Okay, so hopefully that's clear. That's the first step, is to calculate what is my gross amount that will not be forgiven due to salaries and wages. All right, now there's another test that you're going to do to see if you can get all of the forgiveness or not. And the second test is looking at FTEs, or full-time equivalents. So the government has decided, for the purposes of this application, that full-time is 40 hours a week. Now, if you're a company that calls full-time, 30 hours plus per week, then what's going to happen is that all your, even the 30-hour people will be 0.75 full-time equivalents for the purposes of this application. So 30 divided by 40 hours a week, they're 0.75 full-time equivalents for this. And if you have somebody who works 20 hours a week, they're going to be a 0.5 full-time equivalent for the purposes of this calculation. So don't get confused between what your company thinks is full-time and what this loan application thinks is full-time. They've got full-time as 40 hours. Now, if somebody is working 50 hours for you, a scheduled 50 hours, that doesn't matter. It still counts as one FTE. Anything over 40 is still one full-time equivalent. You can't go above one.
Hey, Caryn, this is coming up a lot because you've got people that are working 37 hours a week or 35 hours a week. And on the original application, they said, hey, this was a full-time person, because this wasn't clear at that point. Am I right? Or did it say 40 hours on the original application as well?
The original application, when you had to put the employees in, was just asking for head count. So it's okay.
Yeah.
It's okay.
I know, because I looked at that. I pulled up ours as soon as this came out. I was like, oh, wait a second. And as I pulled up ours, we did just a head count.
It's just
and
head
so
count.
I think that,
You're fine.
okay.
Yeah.
So when you say you're fine, that means that if you've got somebody that works 37.5 hours a week, and on your original application, it was a head count, I think it's kind of an explanation to your lender saying, hey, you know, this is how we originally considered them, or how do you think you should handle that?
Well, you didn't have to report full-time equivalents in your loan application, really.
Right.
That wasn't an important thing. So you're going to basically, you've already, from a headcount perspective, you're reporting what you reported then, because that's a check that the government's doing. They want to see what's your headcount. But now for the forgiveness, this is really the first time we're getting into, you know, this concept of full-time equivalent. So it'll be fine. You know, you're not going to have, your banker is going to know that headcount is not full-time equivalents. If I've got mostly part-time people, my headcount will be almost double, you know, what it would be if for the FTEs.
But what they're really looking at is they're looking to see if you had a bunch of people that were full-time and they were working 30 or 40, or let's say 40 hours a week, and now you've got them on there working 15 hours a week and you're paying them a lot less.
Yes, exactly. Because again, keep in mind, this is, their thought is this is an employment scheme, right? That's what they're looking for, is for you to keep people employed. So they're very concerned. They're not just concerned about, you know, did you cut the wage of an hourly person? They want to know, did you cut their hours too? So they really want this. They really want to understand both the dollars and the hours. So this is the hours part. Now, the base period, there's 3 base periods that you can choose, and you can choose whichever is the most beneficial to you. So let's go through those. The first one is February 15 through June 30, 2019. And you recognize that period because that was in your PPP loan application too. The second period is Jan 1 to Feb 29 of 2020. So that's the second period. If you weren't in operation in 2019 for some reason, but you were in 2020, Jan and Feb, then you could choose this one. If you're seasonal, if you only operate in the summer, you're a camp or a summer school program or a summer dancing or just something that's seasonal like that, then you have a third option, which is you can pick any 12-week consecutive period between May 1 and September 15, 2019. Okay, so you've got a lot of options here, and you can just pick whichever works best for you. The average FTE during we've talked about this, that it's up to 40 hours, and that to get the FTE calculation, you're going to be dividing by 40. Even if you think it's full time, at 30, 35, 37 and a half hours, you're going to be dividing it by 40. Now, there are some exceptions to reducing the FTE count, and these are important, so we're going to go through these explicitly right now. So the exceptions are these ones. Let's just say you had an employee who rejected a good faith written rehire offer. Well, in that case, if you can prove it, you got the documentation that in writing that you did this, then you do not have to count the FTE reduction. You can count that as a, still a person, who's in place. You not have to count it. All right. So there's one. Another one would be if you fired somebody for cause. The government isn't going to say to you, you have to keep that person on if they stole something or they did something egregious. And so if you can fire a person for cause, that person too, you can continue to take their FTE position and hold that from a credit perspective. If somebody voluntarily resigned, in other words, it wasn't something you did, they just voluntarily resigned. Life happens to people, right? They have to move on for reasons. And so if that's the case, then that too will be an exception. And you can calculate the FTEs using that FTE position there. And then finally, if the employee requested a reduction in hours and you gave them that upon their request because they wanted it, then that's not going to be held against you either. So those are the 4 exceptions. I just want to be sure to say that you've got to document those. That could be something that that somebody will come back and want to see later right? So, and those are sometimes a little hard to document, so make sure you involve HR. Okay, so here's where things, I mean, this adds, you know, if you think it's a lot of work going through and trying to pick your periods and doing all those calculations above, this one's even funner. The limits on forgiveness can be ignored if you made, and this is a two-step thing. So number one, you're looking at February 15 and you're saying reductions were made from February 15, the number of FTEs you had and at the salaries that you had through April 26. Now, how did this period get picked? My goodness, Feb 15 to April 26. Well, that's 30 days after the implementation of the CARES Act. That's how that latter, the second day came out. Okay, so what they're really saying is, look, from the start of the pandemic until 30 days after, at which case, you know, you should have your strategy pulled together, right, for employment and all that, based on the PPP loan program. So they've given you this period and said, if you reduce during this period and then restored either the pay or the hours by June 30, then that can affect you. It can create kind of a safe harbor. Okay, so as long as it's restored by June 30. So that's great, but it's a lot of calculations to get there. So there's a separate calculation for the FTEs, which the good news is for the FTE calculation, that's not person by person, it's just in total. So you're just gonna, you know, if you replaced one person with two people that are actually working 20% more hours, that, you know, that 1.2 is going to fall through to the total and increase it, and it's going to help you in this safe harbor calculation. But for the salary and wage, it's person by person. You're going to go through and you're going to calculate your safe harbor, you know, whether the forgiveness can be ignored person by person. So you still might end up with, even if you're going through the safe harbor on a person by person basis, you still might end up with something less than 100% on your forgiveness. And these calculations are complicated. So, you know, you can see my ouch there, these highlighted pieces here. It's a lot of real estate on the spreadsheet is devoted to these calculations, and these are what make it a little complicated when you get into the spreadsheet. But if you meet those two criteria, if number one, you reduce your employees in that first period, and number two, on June 30, you raised them back up, then you get forgiveness. It's as if you never made those reductions in the first place. Okay, so let's go ahead now. Hopefully that's as clear, or at least as clear as mud. And let's go through and continue looking at the application. Now, this is the bottom of page 1 of the loan forgiveness application. And as you can see, it is basically summarizing up everything. So you're going to put in here your payroll costs, your mortgage interest, your business rent, and your business utilities. So all the things that are potentially forgivable are in that first section. Okay, so a key thing here is going to be the payroll cost, and we're going to look at that in the PPA Schedule A, line 10. So I put a 1 by that because I'm going to try to tag as we go through all the different schedules, what's coming up and summing back up to this one simple concept of payroll costs. So that's what the 1 is representing. So once you've got through line 4, you've got all your qualified costs in there, then you're going to then start looking at your adjustments. Your first adjustment will be the wage and salary reduction amount. And that, as we talked about, that will be done employee by employee, and then just add it up, and you're just going to get a gross amount of reductions for anybody who you reduce more than 25%. The amount of salary you reduce beyond that is going to be summed up employee by employee and put on this line. So we're putting a 2 by that because that's a calculation we want to track and think about, and so that's the 2 there. And then you're going to reduce your gross amount by those reductions in the salary and wages. So that's what you're getting to in line 7 here, or line 6. And then in line 7, you're actually going to then calculate the FTE reduction quotient, and that's we're going to look at that too. I'm putting a 3 by that because that's another complex calculation there. And so you're going to essentially then summarize up at the bottom what your forgiveness is going to be. So line 8 will be basically just looking at, you're going to take your FTE reduction quotient and multiply that, whatever that is. If you had a 20% reduction in hours, then you're going to have a overall FTE number of 0.8 or 80%. You're going to take that 80% of your gross or what's qualifying after the salary and wage reductions are made. So that's what's going to go on line 8. So that's one potential amount of forgiveness. The next line is just simply what is the amount of your PPP loan and gross, because that's going to limit your forgiveness in total. You can't get forgiven for more than what your loan is. And then line 10 is going to look at the 75% requirement. So remember, we talked about the fact that your payroll costs have to be 75%. So you're going to actually take those payroll costs from line 1 and you're going to gross those up. And if the amount of your forgiveness exceeds that, then you're going to be limited for what can be forgiven in that line. And then the bottom line here is just saying, look, take the smallest of those 3 numbers, and that's what your loan forgiveness is going to be. Okay, so that's the summary. Now let's dive in. We're going to particularly look at these 1, the 2, and the 3. What are the payroll costs? Let's look at the salary and wage and FTE reductions, and look at the safe harbors related to both. So,
hey, Caryn.
Yes.
Let me. Then I'm sorry. This is the certification. I wanted to kind of address some of the questions that people had, if we can.
Okay, let me go back to this. And what other questions coming out, Charlie?
Well, there's a lot about the alternative payroll period. And
okay.
Do you have to use the alternative payroll period for the non-payroll expenses as well? So it says, here's the question from Annette. If I use the alternative period for payroll, are you saying I have to use that also for the non-payroll expenses?
That becomes your covered period. Yes, that becomes your covered period. Okay, so that it's for everything. It's for everything. You just have the 56 days just starts on a different date, but once you pick that, that's the first date, and you're going to have those 56 days from then for all costs, not just the payroll costs, all of them. So good question.
Okay. Let's do a couple more. If Rachel asked if a person that did not return after having a baby in February was counted as a reduction. Wait, that did not return was counted as a reduction. Would they be considered a reduction now? I'm sorry.
So in the safe harbor, well, in the calculation, if they ended up not returning, so they were on leave and then they didn't return, then that would count. That person would be a voluntary resignation. So that would be adjusted for in your calculation, and you would not be suffering the penalties. Now, let's just say you replace that person. Okay, then the FTEs of that new person, you can't add another FTE. So when you're replacing a person, you're only going to have the FTE of the new person. So let's just stick with that somebody was on maternity leave and then they quit, and you immediately hired somebody else. You might say, well, it's a different person. I'm going to add another FTE. I'll have the FTEs for while she was there, and then I'll have the FTE for the new person. It's like, nope, it's you have to, it's 2 lines, but you have to add those 2 together. That's a single FTE. That position is a single FTE. Okay, so that's important to know, that the government has said if you replace a position, you're not adding a whole nother FTE. It's a replacement position. Okay. Any other quick questions, Charlie, before we move on? Yeah.
People said, will this be available after the webinar? Yes, it will. The slides and a recording of this webinar will be available afterwards, but the worksheet that we hope to get to is going to be something you'll have to email info@missionwell.com to review the worksheet, or to receive the worksheet. And that's because we want to send out updates if there's changes and things like that. And I'm going to let Caryn manage all of that. So she'll be in touch with you as that's being updated. A couple more here. Let me just, unpaid leave. I think we're good on that one. Here's some weird ones. No offense that I say it's weird, but there's so many weird situations. If we pay a W-2 summer minister a retainer for potential extra services such as funerals, can we include the retainer in forgivable payroll expenses?
That sounds
like a retainer for somebody?
That sounds like a cash compensation expense to me.
Yeah, and the retainer will not impact the FTE calculation since there are no specific hours. Yes, kind of an exempt person that they'd be bringing on, right?
You know what? Hold on. So if this retainer is being paid to a pastor who's a contractor, then no, right? Because contractors don't count. If it's a staff member who you're paying additional or supplemental compensation to, then that could count. The retainer could count. And yes, even if the retainer is counting from a salary perspective, it might not affect, let's just say they're full-time and you pay them a retainer because they're working hours 41 through 45 doing funerals or something, and you're paying the retainer to do that. So it's only going to count as one full-time equivalent for that employee who's getting that retainer. But again, if that person is a pastor who doesn't work at the church and who's not an employee, it counts for neither. It's not going to count as salary because it's a contractor, and contractors can go and get their own PPP loan. So they're not includable in your PPP loan.
But she's saying that like a short-term W-2 employee. So this would be an actual employee. So well, there's lots of what ifs here. And you've got to work through these all, each one of them.
If it's
okay, I'll let you keep going because I could distract you forever on these things.
Okay.
Because we've got quite a few that are coming through.
We'll try to get you some more if we have the time. Okay. So
and Caryn, let me say one thing though. One thing is that a lot of people are looking for a definitive answer because we've got all these unique situations, and there aren't guidelines. But again, we want to say, hey, I hate to say wing it when it comes to things like tax issues and forgivable loans and stuff, but you've got to make a judgment call. You've got to put things in yellow, have that conversation with your lender, and you want to put as much in there as you can, and let them disallow some things if they need to.
Yeah, and I think for some of you, you're going to end up calling an attorney or a CPA. Okay, that's just the truth. You're just going to want the guidance. It's going to be important enough to you that you will. So, but for those of you that are smaller, you're going to do your best with your lender. So these are the certifications that you're going to make. And you're going to be, you've already done this before, that you're going to swear that these costs are being used for eligible forgiveness costs, the payroll, the mortgage, the rent, the utilities. And that you've done your calculations correctly of the salaries and the full-time equivalents, and that all your calculations basically are correct. So this accuracy comes out a lot in these certifications. You need to be truthful and you need to be accurate there. And if you're not, then there could be penalties. So these are, again, most of these just relate to your being truthful or being accurate. But I wanted to point out this third one here just real briefly. I've submitted to the lender the required documentation. We're going to go through, if we have time at the end, we'll go through what is the required documentation. If not, we've got the required documentation in a tab of the worksheet. Okay, so you can go and look at it there. And then, again, all the rest of these are just saying, you haven't broken any of the rules. And that you're authorized to sign this form, and that you understand the SBA can come and, ask you further questions to evaluate your loan and your loan forgiveness, and that your failure to provide that information could get in the way. And then you'll just get it signed by an authorized representative. In a sense, what you're doing here is you're converting a loan to a grant. So whoever is authorized in your organization to, accept a grant or to do a transaction like that is who you would, want to make sure is signing this. Now, remember we talked about the fact that there's multiple pieces to this application. We're now moving on to the second piece. So that, what you saw before, was the basic loan application, which just summarized things up. It collected a little information about you at the top of page 1. The bottom of page 1 was the summary. The reverse side was all the certifications. Now this then is Schedule A. Some of these numbers are going to then feed up. You remember I showed you the numbers 1, 2, and 3, right? So I'm showing you here, this is getting to the point where you can calculate the 1 and the 2 and the 3. That's what this is doing. And then to calculate some of these, you're going to have to actually go to an employee by employee worksheet, okay, and calculate things person by person. But let's just stick with this for right now. So for the PPP Schedule A, you're going to be entering a number from all these first 5 lines. Okay, let me just to simplify this. It's box 1, box 2, box 3, box 4, and box 5 from the worksheet. So this is the summation of all the person by person information is coming up or rolling up into the spreadsheet. When we look at the person by person information here, you'll see that they're looking for the cash compensation during the covered period, the average FTEs during the covered period, and then there's the reduction calculation. We've talked about that if compared to the first quarter of 2020, if you had employees whose pay you reduced by more than 25%, then you're going to have to subtract something. Okay, so that calculation then is the box 3 on the worksheet, or the line 3 here in Schedule A. There's a place to check here if you didn't have any reductions. Okay, so if you already know there weren't any, there's just a place to check, and you can shortcut some of this. So that's a good thing. If you can do that, that's great. If you absolutely know and you don't need to go check any records, you're like, I didn't touch anybody. I mean, check your record just to be sure anyway, but then you can just check the box and you don't need to go through the level of detail of the worksheet for this. The reason why there's table 1 totals and table 2 totals for line 1, line 2, line 4, and line 5, they're duplicate lines, is because table 2 is looking at the employees who are earning more than $100,000 a year. So those employees are going to be used for some calculations and not used for other calculations. They're going to be in your total what you spend. So they're going to be they're qualified forgiveness up to $100,000. In other words, I have somebody who I'm paying $120,000 to. I can seek forgiveness on $100,000 of the $120,000. All right, so you want to put them in, but because you're going to have to cap their salaries, and sometimes these people aren't going to count for certain things too. So the Schedule A worksheet is separating these the higher paid employees out, so that it's really clear. These, the top part is for the people who make less than 100,000 or less, and this is for the people who make more. Then you've got the rest of the payroll costs in the covered period, lines 6, 7, and 8. And we talked about this before. Vision, dental, and HSAs, etc., aren't in here anywhere. It just says health insurance. So this is where I would put those costs. I'd put those here in line 6 because they are, they're not health insurance per se, but they're related to health insurance. And, it's our understanding that those do qualify right now. So, put them on your spreadsheet, highlight them in yellow because it is not clear yet. But if it gets clear, and if your lender allows, you're going to put that here on this line 6. All right, line 7, the total amount paid by the borrower for employer contributions to retirement plans. This could be 401k, defined contribution, defined benefit. Those amounts that the employer is paying are going to go here on line 7. Line 8 will be for those state and local taxes that you pay that are based on compensation. And it can't be what the employee pays. It can only be what the employer pays. That's going to go in here. All right, and then line 9, for the most of you will be able to ignore line 9. Line 9 is if you you have a partner or an owner, and some of you do have LLCs or general partnerships as part of your ministry. So if you do, the people who are getting self-employment are guaranteed salary payments. This is what it's going to happen here. But for 99% of you, you can just ignore that and just put a 0. And then what you're going to get to at the very bottom of this section here is the total payroll cost. So you're going to be adding up all the applicable lines, and you're going to get to your total payroll cost. So that's what you've done here on this part of this page, is you've gotten to total payroll cost. Now,
what does it say about workers' comp there, Caryn?
It doesn't address workers' comp specifically, but the guidance.
I know it doesn't. I know, but a lot of people are asking, should we include our work comp? And I'm like, include it, highlight it in yellow.
You can highlight it in yellow, but the word that seems to be coming down is that it's not eligible. So, you know, I've read several papers by attorneys who are now at this point, you know, even if they were initially saying, yeah, probably includable because it's clearly a payroll cost, now they're saying no because it's not related directly to payroll. It's related on the classification of the person as an office worker or, you know, some other more dangerous occupation, the workers' comp is. So it's not really directly related to payroll. So now they're saying no, it's not going to count. So I would, you know, you can put it in and put it in yellow, but I wouldn't count on it at this point in time. I think we know enough today to say that it's not going to be included. All right, so let's look at the, this is the bottom of the first page of the PPP Schedule A. And what you can see here, this is again tagged with the number 3 because it's going to roll up into the main summary application. This is the FTE reduction calculation. And basically, you remember we talked about the fact that you can choose one of 3 reference periods. You can either choose the period from Feb 15 to June 30 of 2019. You can choose the Jan-Feb 2020 period, or if you're seasonal, you can pick any 12-week period between May 15 and September 30th. I think was the range. And so, you know, you're gonna once you pick that reference period, you're gonna calculate during that reference period what the FTEs are in that chosen reference period. And then what you're gonna look at then is the FTEs that you calculated up above. All right, so you calculated up here, you have your FTE calculations here from the covered period up at the top of the page. So you're gonna go gather line 2 and line 5, or box 2 and box 5 on the next sheet that I'm going to show you. And you're going to put those here, and then you're going to ratio those, all right, here. So that ratio then, if the hours fell by 20%, you're going to have a 0.8 or 80%. So you've dropped your hours by essentially 20%. So that then is going to affect, hypothetically at least, the amount of your forgiveness. And if this says 80% on line 13, then you're going to be multiplying up on that the application itself. You're going to be multiplying the gross amount available less the salary and wage reduction times this 80%. So you're only going to get 80% of the amount forgiven if this calculation says it's 80%, for instance. Okay, so now let's look at the worksheet. Now, let me just remind you, this is, you know, down here you see the box 1, box 2, and box 3. Here's the 2 for box 3. So that went back up here for box 2, and box 3 is here. So what you can see is that those boxes here, box 1, box 2, box 3, box 4, and box 5, are coming straight from this worksheet. Now, behind all this, there's a lot of additional calculations, and I have to say that because it looks like it's pretty simple, but to get to the actual forgiveness amounts, there's a lot more calculations. But this is the, you know, kind of at the top level. You're going to list all the employees in this section in table 1 who make less than $100,000 or less. Okay, and then these are going to be the folks that earn more than $100,000 down here. You're going to add up all their the qualified cash compensation, no matter how much they earn, and it's going to go in this column. And then you're going to calculate their average FTE, again, keeping in mind the 40 hours per week. So however much they earned from week to week to week, they worked from week to week to week, you're going to be taking average over that period per employee, and then you're going to be taking that average of all those employees, and then taking your average in total for the organization FTEs. Okay, and you're going to do that once for people who earn 100,000 or less, and a second time for the people who earn 100,000 or more. Okay, now this is the gross salary or wage reduction. So if you cut people's pay by 25% or more, by more than 25%, then this is where you're going to be recording that amount. This is the gross amount of the reduction. Now, it could be that there will be a safe harbor that eliminates that, but you're still going to be calculating this. You're still going to calculate this on this worksheet and fill this in, and then you'll find out, from the safe harbor whether you're going to need to use this ultimately in the main first page summary part of the application or not. You see how there's not that they don't have that down here? They have it up here, they don't down here. That's because you're only going to take a reduction for employees who make 100,000 or less. If you had an employee who earned more than 100,000, let's just say they made $200,000, and you cut their pay by 75%, so now they're making $50,000. The government really doesn't care. They're saying you're a highly paid employee, you've been highly paid. We're not going to get concerned with that. It's not going to count against you. It's not going to go into this gross amount of forgiveness. Basically, the government is just saying, that's between you and that highly paid employee. The only ones that are going to count against you is if they make 100,000 or less. Okay, so you can kind of see how this person by person detail then is feeding up there. Now, I want to talk you through something that could make this calculation here, this employee by employee calculation of these average FTEs, much, much simpler. And that is that you can elect an alternate simplified FTE calculation if you want. So the way that would work is this: if somebody works 40 hours or more, you score them as 1 full-time equivalent. If they work less than 40 hours, you score them as 0.5. Now that's true if they work 10% or 90% or 99% or 15%. Anything below 40 hours would just be scored as a 0.5. Now you're thinking, well, gosh, if I have a lot of people who are between 0.5 and 1, I might end up getting hurt. Well, no, you're going to take this methodology and apply it in your base period too. Okay, so the reference period that you pick, you're going to apply this same methodology. So if you had, let's just say you're a small organization, you have 4 part-time people of varying percentages, and then you have 1 full-time person who works 40 hours plus. You can see how much easier it's going to be to go back to your reference period and just put 0.5 for all those employees for all those weeks, and 1 for the one employee working full-time, and then total those up to get your total FTEs. And in fact, you don't even need to do the calculation probably, because you can just say, look, it'll be 2.5. I'm going to have 4.4 that are at 0.5, which is 2, or excuse me, it'll be 3. And then I'm going to add my 1 additional full-time person, so I'm at 3. And then you can basically do the math in your head for the forgiveness or the covered period too. You can say they all worked, they were all stable, so it's going to be 3 for that. So it was 3, and now it's still 3. And so you can see then that that's going to make it much, much easier. You're going to have to do so much less work, if you can adopt this, and if it's useful to you. So it may be very useful to you to look at this. Otherwise, if you're going by hours, it's going to be every week, looking at the hours each person earned each week during the reference period, looking at the hours that same person worked during the covered period, taking the averages of those 2 periods, comparing the averages, and dividing those by 40, and then taking the difference to say, look, that's your reduction. So this is a much simpler way. Now let's talk a little bit more about that salary and hourly wage reduction. This is not in the application. It's not in the PPP Schedule A, and it's not in the Schedule A worksheet. This is detail that you're going to have to do person by person, in addition to this, table 1 and table 2. Okay, this is additional. You're going to need to, and you'll see that our spreadsheet is set up to add more columns beyond this work so that you can look at some of the safe harbor and some of the more detail of the calculations that the government is asking for. So what this is essentially saying it's the calculation of whether you've exceeded 25% salary reductions or wage reductions. And the technically in this, and this goes on for another, no, it's fine. I think I cut and pasted it. So these steps here, you're supposed to go through it. If a person is salaried, you go through it, with their salaries. If they're hourly, you put in a wage. Once you've done check the wages to see if the wages were cut more than 25%, then you're going to go back and multiply by earnings. Now, as a shortcut in our spreadsheet, we just, are looking at just earnings because you should get to the same answer here. But here, what you're seeing is that they're taking it in 2 steps. So you're going to first of all go through, and you're going to calculate the the average salary or wage during the covered period or alternative covered period. You're going to go back and look at the first quarter. That's this next B, step 1B. You're going to go back and look at what that person earned in the first quarter, and then you're going to divide the covered period earnings on average by the first quarter period average earnings. And you're going to then say, look, did they fall? You're going to put them on a comparable basis and look and say, did they fall? Okay. So, and then if they fell by more than 25%, then you're going to move into and say, now I want to look at the safe harbor calculation to see if I need to report that or not. So step 2 is looking at the safe harbor for each employee. So you're going to basically now for this, and I want to remind you of the slide that we talked about, the conceptual slide that said you're only eligible for the safe harbor if on February 15 you had X employees, and then over the average period from February 15 to April 26, that oddball period, if then the amount was reduced. So that you have to do that. You have to actually check that first to see if you're even eligible for the safe harbor. Once you check that and you're sure that it was reduced, then the safe harbor is that if as of June 30 you restored the wages, the salary and wages, then you're fine. Okay, so that's what the rest of this is doing here in this calculation. And if we have time for the spreadsheet, I'm looking at my watch, Charlie. It's 12:13. We may not have time to do the spreadsheet. But when you write to info@missionwell.com, you will see that we've got all the columns in the spreadsheet that will help you with all of these calculations. So it's a lot more.
Hey, Caryn,
just in the application.
Do you mind, because I'm looking at the next slide, if we jump to the next one?
Sure.
This is a lot of this is helped. We're helped through this by looking at the spreadsheet. Do you mind if we jump to that real quick?
The spreadsheet?
Yeah.
You want to jump to the spreadsheet? Sure, let's do that. All right, so let's, I'm going to escape here and do a stop share, and then I'm going to pull up the spreadsheet then. All right.
Okay. Thank you for being so excited about this stuff.
Oh.
You said funner. You're like, oh, this is a funner way, which isn't a word, but it was great that you were so excited. It's like, oh, this is, I like this. So appreciate your joy. Because
No
I'm
worries
just
there.
really glad that Jeanette in my office is paying attention, because I'm struggling with this.
I get that. So this should be, you should now see the spreadsheet.
There we see it, and this is the spreadsheet. And where do you get it?
info@missionwell.com. info@missionwell.com. Okay, so I'm not going to go too much through this summary. It has multiple tabs in the spreadsheet. You've got definitions, a summary, salary and wage reduction, the full-time equivalent reduction, and the document requirements. Remember, I promised you we'd stick them in the spreadsheet. So, here's the document requirements, because we're not going to have a chance to go through those.
That's great. Hey, make it a little bigger, would you?
Oh, sure. You tell me, Charlie, when it looks readable. Does that look readable?
Oh, that's okay. Yeah, I think that's good.
Okay.
It just take a few minutes to go through this.
Okay, great. I think there's some way I can do a ribbon thing here too to get rid of some of the auto hide the ribbon. Yeah, to put more on the screen. Okay, so hopefully that'll help as well. Now, so this is the summary then, and what you'll see here is that we have a total summary, you know, where you're grabbing information not only from this first tab, but from the salary and wage reduction tab down here, and from the full-time equivalent reduction tab down here. So in summary, then you're going to have your covered payroll costs. You're going to have your other covered costs. There's going to be a check to be sure you didn't exceed 75%, or you'll be limited for that. And then then you'll have your total covered costs at 100%. Then you're going to have a gross safe harbor, a net safe harbor, you know, after you've looked and seen if you meet the criteria, and then you'll be able to take the smaller of the two reductions. All right, and then so you're going to take this and then minus the smaller of the two reductions will get you here. And then you're going to apply your FTE ratio. Okay, if your FTE ratio was maybe, you know, maybe at about 10% cuts as shown here, but after the safe harbor you're at 100%, then you're going to get 100% of this number, okay, here. So that's kind of this little summary tab here. Now over here in the spreadsheet, you're just simply going to be filling out, you know, different bits of information. You're going to put the start date of your disbursement. It will calculate for you then the end date. And depending on where you put the start date, if you put the start date here, if your payroll is biweekly or more frequently, you can put your payroll, your disbursement date here. And that will matter later in the spreadsheet. So put it in the right place. If you're going to do, if your payroll is less frequent than biweekly, you must choose this. If your payroll is biweekly or more frequent, I do suggest you choose this, and the spreadsheet assumes you're going to choose this. Then you're going to choose your pay period here, semi-monthly, monthly, whatever that is. And then down here, you're going to, this is going to calculate initially the covered cash compensation costs, and this is going to come from your payroll reports. Okay, you're going to get the gross compensation. You're going to subtract off the excess cash in excess of 100,000, and then you're going to, if you had any employment taxes that were in that report, you're going to make sure that you've reduced or taken those off, and then that's going to be your covered cash compensation costs. The covered non-cash compensation costs here are going to be, you know, again, keep in mind, incurred and paid, except the final one before the due date, are going to be shown here, and we've got categories for you here. And then the sum of these two, the covered cash and the non-cash, will equal your total payroll costs, covered payroll costs. And then you've got a section down here for other covered costs. Now, the way this is laid out for the cash compensation is that you've got your, you're going to put anything that's pale blue, you're going to input into the spreadsheet. And you're going to put in your payroll start and your payroll end, and then the spreadsheet will calculate for you what the allocation is. Okay, so in this case, it's 10% because up here, you had a date, a start date for your loan forgiveness period of the 28th. So that's the 28th, 29th, and 30th, 3 days. And then you've got 30 days. This is a monthly, this is assuming a monthly payroll here. Oh, I see that I have that. Let me do this monthly. It's a monthly payroll here. So you're going to have the first payroll will be allocated, and you're going to take 10% of that 3/30 of that, first monthly payroll then. And then, so that'll be there. And then your second payroll, you'll include all of it. Your third payroll, because your monthly will not be used 4th to 6th or the 8th, these are all just saying not used. And then your final payroll period that will be covered in the loan forgiveness will be June 1 through June 30. And again, that will require an allocation. So we'll go through and it'll take the end of your PPP loan, and it will calculate, again, what portion was incurred or belongs in here. Now, this is there could be a little bit off. Just keep that in mind. This is meant to be a tool for you. It's not the actual application, although a lot of it can, flow into their one by one. But if you have a lot of hourly people, you probably have to go separate their hours. You can't just use an allocation, right? So if you have hourly, you probably need to do a separation there. But there you go. You're going to have this done then, and you're going to get your total cash compensation costs. It's doing all the allocations of those for you and totaling up everything in the period. This amount then will carry up, to the summary. Then you're looking at the other payroll costs, week by week. Just put them in the week that you paid them, okay? And you're going to do any kind of, you can still, even if it applies to week 8, if it was incurred, you can basically do an allocation there. Your other covered costs go in here, and again, you're just going to put those in when you pay them, all right? As long as they were incurred in the same period, and if it's rent or whatever, put that in. And if it's you pay rent twice, put that in twice. All right. Now, then the salary and wage reduction, we're getting into it's long, because you have to go through quite a bit of calculations here. So this initial section over here is going to have the employee's name, the last 4 digits of social security number, which is required for the loan application. And then you're going to do a check and see, did anyone make over 100,000 in any pay period of the prior year? So the spreadsheet will tell you, based on what you've picked for your payroll, if it's monthly, it's going to say basically, $8,333 here. And that's the threshold you're going to look at. You're going to then type in yes or no. Okay, so it's either a yes or a no that's going to go in here, and that's important that you type in the yes or no, because you need to know that for some of these future calculations. Then the spreadsheet does a base calculation here of the quarterly, from your quarterly payroll report for the first quarter of 2020. Plus any adjustments that you need to make. Whatever adjustments you're making here, keep in mind you're probably going to need to make here, although we don't have the space for it in the spreadsheet. But this is a way for you to just think through, how am I going to record this? You need to use the same methodology in your base that you're going to use in your payroll period. So think this through, whether there's any additions or subtractions you need to make. Then you're going to get your gross cash compensation. This number is equivalent to what you're going to be putting in then person by person during the covered period. And then you're limited, you're capped. You can only use up to 100,000. So anybody who earned, this person here earned in the quarter 50,000, which means that on an annual basis, or I've converted this here to a covered period basis here. You can't claim more than $15,538. Okay, so you'll see that number repeatedly. So if this is at 15,538, that means that they earned more than 100,000 on an annualized basis. So this is converting to allow you comparability. It's converting these quarterly numbers to the covered period basis, and using capping anyone who's making over 100,000 on an annual basis. Now this is your basic place where you're going to enter, for all those people, all your people in here. And then the spreadsheet for you will adjust the first payroll with the gross pay, and it will also adjust the final payroll. And I've kind of hidden some of the columns to make this a little easier, but I'll unhide this just for a minute, just so you can see. And there's a lot of columns here. So if you've got a monthly payroll, it's not going to be too bad. But if your payroll is weekly or biweekly, you have a lot of columns of data here to get filled out. But once you do, you're going to allocate. You're going to do an allocation for the first one and the last one in the period. Always, it doesn't matter how many payrolls you have. You're always going to put your final payroll here. So if you're semi-monthly, you're going to end up in the 8-week period. You're going to end up essentially with 4 pay periods that are going to be covered. But it actually could be 5, because you could have a small piece of one up front, and a small piece of 1 at the end. So the 5th payroll, or if you're so lucky, the 4th payroll, whatever the last one is, you're going to put here so it can get adjusted. You're going to put the first one in the first column, the last one, and then just fill in the rest as makes sense. Okay. So again, you're going to do, there will be a calculation here the spreadsheet will do for you. It'll add up all those payrolls for you on an incurred basis, and it'll calculate the total for all those payrolls, and then it's going to calculate the reduction for you, the gross reduction before applying the safe harbor. So you've got 2 employees in this example here. One employee who his or her pay was reduced more than 25%, so there's a small reduction there. Another employee who was reduced more than 25%, and there's a reduction there. Now, if this employee was reduced more than 25%, it doesn't matter, because they're in the next calculation, and it doesn't matter for this calculation either, because they're going to be capped at 100. They're going to be capped at 100,000 here. So, you know, if somebody making 200 and got capped to 100, it's going to just show that difference falling to 0. Or if they earn 200, if they earned over 100,000, again, you've noted that they earned over 100,000 in this column way back here, then they're not going to get included anyway. They're just going to be excluded in the totals. Okay, so the spreadsheet will calculate that all that for you. Then what you've got here is the salary and hourly wage reduction safe harbor. You're going to initially here, you're going to say, were reductions made into the compensation, okay? So you've got 2 things you got to look at for eligibility for the safe harbor. First of all, you've got the 2019 threshold. Did they earn over 100,000? If they earn over 100,000, they're not eligible for the safe harbor. They're just not part of this. And then were reductions made? So this column, yes or no, is calculated based on going and looking at the column saying, did they make more than 100,000? And also looking here to say, did the pay fall? So their pay had to fall versus you're looking at their pay. What's the conceptually their annualized pay that they were making on the 15th of February? And then you're going to, in this column, you're going to put in what conceptually is the annualized pay for that period from 2/15 to 4/26. That's the period we talked about, that odd period. So once you've done that, you can see for person 1 that their pay fell. They're not eligible though for other reasons. They must have had a yes, you know, in terms of was their pay last year, did they have any pay that was exceeded 100,000 in any pay period? All right, now this person had no pay changes, so they're exactly the same and they're eligible, but there's no amount because their earnings were the same. But if you had put in 40,000 here, let's just say their earnings fell by 40,000, then they're going to be eligible for the calculation. And you're going to see that nothing needs to be taken out or reduced for them because you've restored them back to the 60,000. Okay, so it's going to calculate for you, you know, whether you've restored the person or not. Here's a person who made a wage. They're qualified because their wage was reduced during this next period. The wage wasn't made up, and so this here, you're going to pick up and keep that reduction. It has to stay. All right. This person, you made up the pay, so there's nothing here. This person, you didn't make up the pay, so they have to stay. So you're going to do the safe harbor calculation person by person, and then that amount then is going to be noted down here. It's only going to take some of those, the subset of it. So you've got basically a gross reduction of $820 in this example, and a net reduction of $627. That's what you saw in the summary sheet. Now on the FTE reductions, you've got basically for each of your employees, you're going to list your employees here, and then you're going to, if there's an exception for them, you're going to note that here. And I want to say this right away, I'm not sure how the lenders are going to accept this. They might accept this spreadsheet, but they might say, no, we want it calculated a little differently. So, you know, as we get more experience with doing forgiveness and we see what the lenders want, we'll modify the spreadsheet, right? But for right now, we've had to use our own best judgment in terms of what works. So what you see here—
Can you pull that down again so we can see the pull down options there? for the select exemptions?
Yeah, so if you can see that it says select exceptions, it says the employee
Sure.
rejected a rehire offer. It says they were fired for cause, they voluntarily resigned, or they requested a reduction.
Gotcha.
Okay, so those were the four exceptions that we spoke of earlier in the talk. And so you're just gonna pick the exception that the employee has, or else leave it at select exceptions. Now, the other thing that I put in here just as a note to yourself, like don't add another employee if you replaced someone, right? Just keep them going on the same line and just replace the name of the employee, or, you know, put two names in there and two identifiers, okay? But don't add an FTE. So you're not allowed to add an FTE for a replacement person. So here's a person who, you know, I threw some numbers in here just for, you know, the sake of an example. Obviously this person left, and then, you know, 2 weeks later, somebody else was hired. Okay, but that's all on the same line. It's the same FTE. It's not two, it's just one. Okay, so this is the reference period. You recall that there's 3 reference periods. Okay, we've got the reference periods as noted here. You can just, for your own sake, record which of these 3 reference periods you're using. You can only choose the 3rd one if you're seasonal. But otherwise you can choose between reference period 1 and reference period 2. If it's reference period 2, you're not going to need as many weeks in the reference period. So in this example here, they're using the alternative FTE calculation, and they're using reference period 2. So it's the simplest possible way of looking at it. So the alternative is where you use 1.0 FTEs or 0.5 FTEs for every employee. This person was full-time. It's a full-time salaried employee. It's just 1.0 for each of the weeks. Now, in this case, because they clearly, this one is the reference period here is 2 months. So this is probably biweekly payroll. So they have filled in 9 weeks of data here. In this hypothetical one. In this example here, they've chosen reference period 1. They've got an hourly employee who works variable hours, and they're using the hours worked to calculate the FTEs, not the 1 or 0.5. So let's see how that works. So see, you can see the hours are put in week after week after week through the reference period, okay? As opposed to how simple this is, where you just put in the 1.0 or the 0.5, right? So you can see that the difference here. Down here right now, this is set up to hours, but if you put in the 1s and 0.5s, the spreadsheet will work fine too, okay, for you. So then there's an FTE calculation here, which is averaging up everything. And I remember for the average, if you're putting hours in, it's going to use 40 hours a week for full-time. So it's just, you know, down here you see these, you know, kind of fake employees in there. This is for the reference period. You're going to do the same thing then for the covered period, you know, so you're going to have, you know, up to 9 weeks if you need to, you know, if you're fitting in different payrolls. So we've allowed up to 9 here for you. And then it's going to calculate again the average FTEs. And then if you have an exception, it's going to make an allowance for that. All right. So any place where there was an exception and the FTEs technically fell, but you don't have to honor that because it's one of the allowed exceptions. It's going to, you know, increase the FTEs for you. Now, this is the calculation of the FTE safe harbor then. You're basically going to, you know, you're going to add up all the employees. So you take all the employees that are there and you're going to add up the FTEs, and it looks like for this column A, this is during the pay period that encompassed February 15. All right, so that's in that one pay period there. And then you're going to take here the FTEs during the period from, and again, this you're just going to, you're inputting this data because this is not what you calculated before. This was to get these first 2 blocks. We're just doing the basic calculation to see if you need to use the percent reduction. Now you're seeing if you can ignore those. So, you know, basically you're saying, I'm going to look at the FTEs that they, on the 15th of February, just like we did with salary and wages. I'm going to look at the FTEs over the period from the 15th through the 26th. And then if there was a reduction in those, then you're eligible. You're eligible to look at the you know, whether you have a safe harbor. And if you are eligible, then you're going to calculate your FTEs, wait till June 30th and go calculate the FTEs then. Right, so let's look at the total for those things here. You had on Feb 15, 3.8 full-time equivalents. Over the period from Feb 15 through April 26, you had 3.5, so you had a reduction. You're eligible because you had a reduction for the calculation. And then by the time you got to June 30th, you'd built your FTEs back up to 3.8. In this case now, you're going to have 3.8 divided by 3.8 equals 1. You're at back up at 100%. So when you're going back into the summary here, you know, you're going to be at 100%. Okay, you had over a 10% reduction, but it's not going to matter because you fixed it by June 30. So because you fixed it, you get 100% of what your qualified costs less the salary and wage adjustment was. Now, one other little complication I'll mention that I think we have to call it quits, Charlie, is that the government is not going to cause you to have to double dip. So if you both, if you have an FTE reduction and that person also had a salary reduction, you can just count it in the FTE reduction. So that's a complication that, you know, you'll have to deal with manually, but I just want to mention that. Okay, so this is the spreadsheet. And, you know, hopefully it's just a way to collect the data and make it more clear to you, you know, from a planning perspective and from a, you know, what you're really going to have to collect and do. Most of this is going to be work that you're going to have to do for the PPP application. And so hopefully it'll make a nice organized way for you to collect up the information and to translate it onto the application as time goes on. Hopefully you can use it too to do forecasting for the period and monitor and make sure, did I get this bill paid? You know, these are the things I felt like I was going to be able to qualify up. Did I actually go get those done? And am I good to go? All right, so Charlie, I think we're about out of time here.
We are. We've got about an hour and 40 minutes, I think, at this point. I want to tell everybody we've got the PowerPoint that's going to go out to you that will include some supplemental slides and kind of some FAQs and questions that have come up over and over again. We're going to have the video of this, or the rebroadcast of this. Takes a little while to process, and we'll get this out. And if you go to the website, we have one on HR issues tomorrow. And then Friday at 11 o'clock, we have a webinar on reopening church. I know it filled up yesterday and there wasn't enough room for everybody. But if you go to the website at churchwest.com, you'll find the sign up for the webinar on Friday about reopening church in accordance with the California guidelines, at least the interim guidelines right now. So, okay, Caryn, that was a lot. Somebody said this, Ken said, he says, Caryn should get a medal for the work she put into this and for being so generous to share it with us. So, Caryn, I know you've done a lot for your clients. You've given a lot to other people. Ken owes you a medal.
Thank my staff. I mean, we just have a lot of good group of people, and you know, Linda and our staff will be continuing to work on this, and Tara's worked on the early part. We've just got great people, you know, who really have a heart for our business partners, and we're all happy to help. Yeah, we're blessed like that in our office too. So I appreciate it. Caryn, thank you so much for joining us again. Thank you everybody for joining us. We'll work to get this out to you right away, and we will all talk to you soon, right? Thanks a lot. Bye-bye. Take care. Bye-bye.
All right, bye-bye. Thanks, bye-bye.